Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Amy Zhang, Executive Vice President and Portfolio Manager at Alger, Brian Joyce, Managing Director on the Nasdaq Market Intelligence Desk, and Maddie Radner, Director on the Nasdaq Market Intelligence Desk. We discuss why 2024 could be a comeback year for small cap growth. It is great to have everyone with us today at Market Site. Welcome back to Trade Talks, Amy. Let's discuss what's going on from a macro perspective before we get into the small caps. How would you say earnings is performing so far for Q1?
Well, so far, actually, earnings has been very strong and generally in the companies we own. And in fact, study has shown that Russell 2000 grows the earnings is supposed to grow 2 times of S&P 500. So I think actually the earnings momentum is coming back, which is very positive.
Yeah. So let's talk about what's happening from a data perspective. We saw some wage data that came in hot. Clearly, that's lending to some volatility in the session this morning.
Yeah, it feels like yesterday earnings and big tech enthusiasm really outweighed some of the Fed policy that's going on, and now today Fed policy is back into the picture after hotter than expected wage growth or wage data that came out this morning. Feels like a lot of stickier inflation data has come out, and that's just adding to the theme there. So there's a lot of kind of anticipation with what the Fed will decide tomorrow.
And Brian, even though S&P down about 1% today, about a 3% loss for the month of April, breaking a 5-month winning streak. However, it is up significantly from that October low, as we've been discussing.
Right. We gained about 28% from the October lows into the end of the first quarter. We had back-to-back quarters of double-digit gains. That's only happened about 9 times in the history of the index. We had our best first quarter in 5 years. And so we're now pulling back into April. And we bottomed a week ago, as you can see in the daily period chart, at the this price gap that was formed during the uptrend back in mid-February. And so gaps are potential future support resistance levels here. We've rebounded up to yesterday's high, which hit that converging 20 and 50-day moving averages. So potential resistance there, and then certainly acting that way at the moment. So in the grand scheme of things, we've only pulled back around 5% or so, off the top. If we look at the weekly period chart, we could see here that I would expect that if we do break, the lows that we've seen in the last couple of weeks, if we break that to the downside, and we'll see, if there's a catalyst that comes up this week, whether it's the job number, whether it's the Fed, whether it's the announcement by Treasury, we could potentially retest that 48.30 level, which was the high back in 2021. It was a breakout level during the strong uptrend in the fourth quarter, and it also coincides with the 38% fib retracement of that entire uptrend, which is not really a dramatic pullback. So I think the market can't go up in a straight line. It's going to stair step up and have some corrective price action along the way. There's reasons for it that are macro or fundamental. We've had a dramatic hawkish repricing in the yield curve, and that would certainly, I think, be a catalyst to see some near-term continued consolidation.
And Amy, when you think about small caps for a moment here, they're gaining some momentum. They've been in a bear market for the last 3 years. Do you think some of those headwinds are slowly turning into tailwinds for 2024?
Yes, absolutely, because it's not the absolute rate levels, and we can get into a little later, but it's more about the rapid rate hikes, right, in the last couple of years. It's like 525 basis points since March 22. So that the fastest and furious rate hikes really was very disruptive to all long duration assets. But no matter what, I think we're close to the end, right, in terms of rate hikes. And or we probably will just pause. Even if we stay higher for longer, I think the kind of companies we invest in are still very well positioned. And the valuation, the gap is tremendous. I feel like a truck can drive through it. As you know, we talked about before, still the S&P 600 growth is still trading at over 20% discount to S&P 500. And for the last 20 years has been trading over like about 13% premium. So we think there's still, for both from a valuation point of view, there's a reversion to mean trade catch up. Like Brian said, small companies particularly do not grow in a straight line, and they tend to overshoot, overshoot both on the upside and downside. And we tend to, at Alger, we're stock pickers. We think there's a lot of opportunity to use the volatility as a friend.
Right. Well, you also have a higher U.S. dollar as well.
Right,
which
would be, yeah.
historically does help small caps.
Yes, because we're more U.S.-centric, right, our companies, and also more insulated from the geopolitical risks.
Right.
Yeah, I think off of that, I mean, there's been so much commentary this year that this is going to be the year of the small caps, and I think looking at certain sectors that could be true. So Brian and I were looking this morning, some of the cyclical sectors within the small cap Russell 2000 are either breaking out of previous highs or have the potential to. So looking at energy, the energy in the Russell 2000 is actually up over 500% from 2020 lows. Incredible. They're actually outperforming year to date as well, especially from last October as well. Materials and utilities and industrials also have that potential to really outperform this year as well.
Yeah. And Brian, let's take a look at a couple of charts of the sectors that Maddie had mentioned here and identify those levels.
Sure. So we're starting here out with the Russell 2000 Industrials Index, which has been making new highs since late December. So this looks very constructive. We're in the midst of a little bit of a pullback here, like the broader market is. So nothing too concerning there. And then when we flip over to the energy sector, I think this has, the most potential amongst the small cap names that we've been looking at. We can see that, as Maddie noted, there was over a 500% gain from the 2020 lows to 2022 highs. Peaked right in June 22, right around the height of the geopolitical tensions between Russia and Ukraine. Not that that's gone away, but we've since been consolidating, and we've been consolidating with a trend of higher lows going into a very clearly defined resistance level that's been tested over and over again. The more times price tests a certain level, the more important the market is telling us that level has become. We had a brief breakout above that in mid-April and pulled back. That's not concerning to me. So I'm kind of excited and looking forward to see how this unfolds.
Yeah. And Amy, what is your methodology when you're looking at stock picks at Alger? I mean, it's not just the story that rates may come in. I mean, there's other fundamental matters as well when you're looking at different sectors and different areas of the market.
Yeah, absolutely. We believe, fundamentals drive stock price over the long term, and like Ben Graham said, over the short term, market's like a voting machine, which I feel that's like every day, right? So it's some data every day. But over the long term, at Alger, what we're looking for is to invest and identify exceptional small companies early in their life cycle that undergoing positive dynamic change is really about growth and change, and then those companies will become long-term compounders, become exceptional large companies. So for us, first and foremost, we really look for companies competitive advantage, the moat, right? It's very important to have a wide moat. So that's why we tend to have more science-based company in healthcare and technology to a great extent, because those companies have something truly differentiated, and they can, because they're very small, law of small numbers, and as you know, we define smallness in terms of revenue, and they usually are a disruptor in a large and expanding market, and that will allow them to really compound revenue and profitability over the long term. And they also give them advantage in pricing power, and that's very important as in a market that's staying higher for longer. So that's the most important element. And then also those companies tend to have structurally high margin. Even though they may spend a lot on R&D, we prefer companies spend a lot on R&D instead of sales and marketing. But they still have strong cash flow generating capabilities, and as a result, they have very strong balance sheet. As Jill, you mentioned many times, cost of capital is so important for a small cap, and that's why I think our companies are very well positioned when rates stay higher for longer, because the strong balance sheet.
Yeah, you had mentioned healthcare, and you're looking for innovative companies within that space. What are some of the areas within healthcare you're looking at? Yeah,
actually all areas, because I think healthcare, overall aging population, we are living longer, which is great, but we're also all aging. So to that extent, to have a longer life and also a happy and healthy, higher quality life is very important. So there's definitely the demographics is very favorable for healthcare. And I really think healthcare is both a defensive and offensive sector. That study has shown that, especially in small cap, as a sector that has the largest dispersion between winners and losers. So that, at Alger with stock pickers, I think that that's a fertile ground for us. But in terms of areas, in terms of medtech, a lot of small cap medtech has been oversold because GLP-1, they're still on the rate to recovery and still slow recovery. But we tend to invest in company really address a very important unmet medical needs. And then tools and diagnostic, as you know, especially tools companies, been through very they done extremely well. They did extremely well in the COVID pandemic area, so it's tough comp, right? But now finally, tough comp is becoming easier comp, and they are normalizing and stabilizing. So they are most of them are returning to re-accelerating growth, which is very exciting to see, and we expect most of them to happen this year. And you already saw like Danaher and the Thermo as leading indicators, right, for that. And then biotech, and I think it's a very fertile area because like last year, towards the end of the year, valuation was really very, very low, and it has a brief bounce. But I think overall, again, it's very idiosyncratic, right? We focus on company really have very strong efficacy and safety profile in, again, addressing a large unmet medical needs. And last but not least, we also have exposure in GLP-1. We have exposure in both oral therapeuticals, but also picks and shovel. We have companies that picks and shovels, like they specialize in pharmaceutical grade glassware, which very important for injectable. So I think healthcare is one area it's really oversold, should have a strong bounce back, especially if we muddle through, have a modest economic growth.
Mm-hmm. Yeah, you're seeing that on the desk as well, particularly when it comes to deal activity, right?
Yeah, we're noticing a lot of movement in the healthcare M&A space this year. I'm sure you have.
Oh yeah, exactly. Yeah.
Yesterday there was a over $2 billion acquisition announced. Mm-hmm. So we really see that as a sign of growth and innovation within the space. And as you mentioned, there's a lot of sectors and themes that really haven't been explored previously that investors are interested in this year.
Oh yeah, we already have one long-term, Shockwave was expired, medical, was acquired by J&J, right? Mm-hmm. And also CBay, and we have, some others in our diversified portfolio that biotech companies acquire. So M&A is definitely, we always view that as a put option because we feel the same characteristics that we look for are the same characteristic large company will look for one day, because growth is going to be scarce, right? Especially it's a company that really transformative in the area that they're in.
Mm-hmm. Yeah. Brian, I wanted to quickly pull up a chart of the dollar here. I think that's going to be a key theme for the year, as we move through the second quarter and back half. I mean, clearly it's going to impact the multinationals, but again, that could potentially be a tailwind for some of the small cap companies that Amy and Maddie are taking a look at.
Yeah, so we've been seeing some strength in the dollar really since mid-March when that inflation, strong economic data has been taking off. And more recently, we kind of peaked in mid-April, and we've been consolidating in what technicians I think would call a bull flag here, when expectations from a bull flag is after a period of consolidation to resume the trend. In this case, a bull trend is to the upside. So we're seeing somewhat of a breakout there today. On the longer weekly period chart, we can see we're kind of stalling right around the highs from last summer and fall when the market had, when the U.S. dollar index had, 11 to 12 weeks of gains in a row, almost set a record there. And so we're peaking around that 105, 106.5 level. And we certainly have some catalysts this week that could determine whether or not the dollar has the strength to break out to the upside, or is it going to kind of stall here and then reverse lower.
Yeah, I mean, there are certainly a number of catalysts on the horizon that we have to look for the next week. I mean, a number of big earnings coming out tonight and next week as well, which of course will set the tone for the markets. Appreciate everyone's insight. Thanks for joining us on Trade Talks. Thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.